This week on 7th June, we have 3 power-packed webinars lined up for you. These webinars are in Indian Standard Time. By 11 a.m., we have Smart Insurance Planning for every stage of life. Following that, by 1:30, we have NIO versus Mutual Funds. Invest in the best winner. By evening 4 p.m., we have Decoding the RBI Monetary Policy. Descriptions are in link. Join the webinars. Make your weekend a learning weekend.
Hi everyone, welcome back to the channel. We are going to look at this month's fixed income outlook, and our theme for June is lowering expectations. Now, this might sound like a pessimistic approach to investing in 2025, but when we really think about it, it's a smarter and more grounded way of getting things right. If we're lowering our expectations, it's because we are acknowledging that the market has changed quite a bit. It doesn't matter whether you're a fixed income investor, a multi-asset investor, or even an equity investor, context has changed quite a bit, and we need to get our investing to adapt to the new context. Keeping this in mind, we also will realize that the investing environment has become more volatile and riskier, and it's also been more demanding. So when we recognize that it's not as easy as it was before, a more cautious and measured approach could actually help us go places with our investing. So let's get right into what this outlook has to offer. We're going to begin with analyzing some of the RBI's recent actions. Now, if you've been tracking the RBI's actions, you also know that they're going to announce their monetary policy decisions on Friday, June 6th. So stay tuned to the channel to get that update. You can subscribe to be the first to watch the video. The primary concern for the RBI over the last few quarters has been India's slowing growth. So when they're looking at the Indian economy, there's clearly a growth slowdown that's taking place, and this is something that the central bank has been trying to address. It's not just the RBI's problem. The government already stepped in with union budget tax cuts, which were aimed at boosting consumption. So the RBI has had to bring liquidity from negative to surplus in the last few quarters. So they took a few measures to make this happen. So firstly, they cut the cash reserve ratio in December. Then they stepped in with open market operations, which have been going on from January till last month. And the basic idea is that when the RBI buys bonds, it infuses liquidity into the market, and this has helped move the liquidity from negative to positive. The third important thing that the RBI has done in this time frame is to reduce interest rates. So they moved the stance from neutral to accommodative in April, but the rate cut started all the way in February. So after a long hiatus and keeping rates steady, the RBI cut rates for the first time in February and then again in April. And there's a lot of speculation about what it's going to do in its monetary policy later this week. This isn't the only thing that the RBI has done. One important data point that we were tracking is the dividend that the RBI paid to the government last month. So this came in at 2.69 lakh crores, which is a big number and also bigger than what it was last year. However, market participants were divided about how much the RBI should have paid to the government, because their surplus buffer actually indicated a higher number, and the surplus that they could have paid could have gone up to 3.5 lakh crores. So this gap, what did they do with that extra money? The RBI actually shifted towards risk management, and they chose to enhance its own contingency buffers. This is something that kicks into play in terms of financial stability and making the RBI a more robust institution in crisis times. So clearly, the growth is not the only goal that the RBI has. It is keeping an eye on risk and managing risks within the ecosystem. At the same time, the RBI has also removed a few restrictions and relaxed certain restrictions that it imposed on NBFCs and MFIs in the last year, broadly encouraging banks, NBFCs and MFIs to lend more, keeping more room for credit growth. So let's get into something that almost every investor is guilty of, which is chasing performance. Now, all of us love a proven track record, but track records can actually be misleading when we're looking at what's happened in the past and trying to make decisions about the future. What we need to do is understand the context that we're in today, particularly where we are in the interest rate cycle. So if we understand the outlook for interest rates, inflation and growth, then we have a better decision-making framework in terms of where we move our product choices. So investors need to move away from looking at recent performance, because fixed income assets also perform in cycles, right? So there are different themes that you can play within fixed income, and you need to pick a theme that's appropriate to today's context, which means that it's important for every investor to consider performance potential and not just performance. Thinking about this will help you make better choices in terms of managing risks and grabbing opportunities. Speaking of opportunities, it's a great time to be a fixed income investor. Fixed income has a lot to offer to an investor today. So firstly, while we've had some rate cuts already come in, the transmission of these rate cuts is not yet at 100%. This means that the rate cuts are working their way into the system and into yield curves, and there's still some juice left for you to squeeze out. Now, keeping this in mind, if you're a strategic investor, you could look at duration but pay a lot of attention to your entry-level valuation. The second thing that you need to recognize is that it's been a roller coaster ride for equity investors in 2025. When you realize that this is not an easy environment to be an equity investor, then you need some breathing room, and fixed income can give you exactly that breathing room that you need. So it allows you to systematically as well as opportunistically participate in equity markets. So taking a cash call or taking a liquid call in certain contexts, as well as protect your portfolio from market volatility and prepare for wealth creation. With all that's going on in the world, whether you're talking about geopolitics, tariffs, or slowing growth, there is only one strategy that's going to make you a winner. It's being slow and steady. And that means compromising a little bit on your returns so that you have more safety and flexibility to participate when the time is right. So in fixed income, we have 3 simple rules. It's always better to stick with quality. If you're going to take a duration call, then pay attention to your entry point. And if you want to move down the quality ladder, then assess the risk-reward balance, because as yields move down, investors will be tempted to take more risk from a credit perspective, and you can avoid chasing performance by being an early investor in any theme that you choose. So that's a wrap for June, and we'll see you next month in July. But in the meantime, you can sign up for our webinar, which is happening on Saturday, where we decode the monetary policy that the RBI just announced.